Hello everyone and welcome to the channel. Recently a channel called Dividend Bull made an excellent video documenting every single monthly paying dividend stock as of June of 2022. One thing more eagle-eyed viewers might have noticed while watching through that video was that it was very comprehensive, but it also contained many, and I mean many, low-quality dividend stocks that have only returned massive losses to their investors over the past 4 years. So to help you out, I've gone through that entire list and done deep fundamental analysis on all 40 plus of those monthly dividend paying stocks, and I've eliminated low market cap stocks and all the other poor performing stocks on that list. This list is not going to include ETFs or other closed-end funds. This is only a list of stocks. If you want to see a list that includes ETFs and closed-ended funds, click on this video right now. Number 1 is ADC. Agree Realty Company, ticker ADC, is a $5.2 billion market cap real estate investment trust that leases over 1,500 properties to major retail tenants and industries that aren't in danger of being replaced by Amazon or e-commerce. You can see that in their June 2022 corporate update that their biggest sources of revenue by retail sectors were groceries, home improvement, and car services, followed by various types of retail services such as pharmacies. Their monthly dividend program is relatively new and started only back in 2021. But because this is a larger size company compared to the others on this list, some investors think that this company's relative inexperience with monthly dividends is compensated for by the size and maturity of this company. If you had two investment accounts, each with $10,000 inside of them, and you invested one of those accounts into ADC and one of those into SPY, which is an S&P 500 ETF, you would have earned 11.49% over those 2 years, turning your $10,000 investment into $11,148. And then also, during that time with your $10,000 investment, you would have been earning $407.16 every month in dividends at a 4.05% yield. The only trouble is that going back to the other $10,000 account that you invested in SPY, that account would have gone up in value by 17.16%, leaving you with $11,717, meaning that ADC underperformed the S&P 500 over the last 2 years. Now, at the same time, though, SPY wouldn't have been paying you $23.47 a month in dividends, so for some investors, the passive dividend income is more important. However, you should be aware that this monthly paying dividend stock did not outcompete the S&P 500. The good news, though, is that if we expand our analysis out to 4 years, including 2 years before the coronavirus pandemic and 2 years afterwards, ADC actually did outperform the S&P 500, growing 57.9% versus just 47.06% for the S&P 500, starting on January 1st, 2018. Then finally, a quick look at the revenues and earnings over the past 4 years, starting in 2018, shows that the revenue has been growing pretty consistently every year. And as you can guess, as the revenue has been growing, so has the amount of dividends they've been paying out to shareholders. Next up is CRT, which is Cross Timbers Royalty Trust, and this is a $117 million market cap express trust in the United States. Get ready for a technical explanation. It holds 90% net profits interests in certain producing and non-producing royalty and overriding royalty interest properties in Texas, Oklahoma, and New Mexico, and 75% net profits working interest in 4 properties in Texas and 3 properties in Oklahoma. The company was founded in 1991 and is based in Dallas, Texas. But in practice, what this corporate talk means is that they just operate oil derricks and then export that oil to producers and other various distributors. Because this company is a royalty trust, it may complicate your tax filings if you own this stock. And that's because if you're holding units in a royalty trust, it means that you have to file a Schedule A and Schedule B1 through B12 on your tax return. And you can see from the 2021 tax information they released on their website that the tax implications of owning this stock can be very complicated. And so what this includes, but isn't necessarily limited to, is that you have to phase out your taxable income through a royalty structure, along with other difficulties. The tax implications of owning this stock is outside the scope of this video, so do your own research and consult with your tax preparer for more information. You can see that their dividend has increased significantly in June and July of 2022, but that is mainly because of the recent dramatic increases in the price of fuel and energy. And looking back at previous years, this dividend has fluctuated dramatically in line with the price and demand for oil. So investors looking for a stable, consistent dividend should be aware of this. But if you don't mind the extra tax preparation work and want to speculate on the price of oil and energy while owning a monthly dividend stock, this may be what you're looking for. A $10,000 investment in CRT in 2020 would have grown to $25,489 or 154.92% as of the making of this video. But if you had invested in 2018 instead of 2020, that $10,000 investment would have only grown 78.9% and would be worth $17,891, which is smaller in comparison but still dramatically outperformed the S&P 500. CRT has a dividend yield of 7.84%. If you were to invest $10,000 in CRT, you would earn about $139.36 a month in dividends, but this is hard to estimate and would fluctuate with the amount of revenue CRT is making, which is also heavily linked to the price of oil. The next stock is Gladstone Investment Corporation, or ticker symbol GAIN. This is a $477 million market cap company that was founded in 2005. And what GAIN is it's a private equity fund focusing on acquiring mature, lower middle market companies with attractive fundamentals and strong management teams. GAIN provides both equity and debt capital, which greatly increases certainty and speed of closing, as well as provides GAIN shareholders with both current yield in the form of monthly dividends and potential capital gains upsides. GAIN typically invests up to $70 million of debt and equity in a transaction, and most of the businesses they invest in are market leaders in stable industries that have profitable operations and strong management teams that have proven their results over all kinds of economic cycles. In terms of performance, GAIN year-to-date has outperformed the S&P 500, losing only 12% versus 18% for the S&P 500. Their dividend has been increasing pretty steadily, and these large spikes you can see on the dividend history graph are special dividends that the company pays out when they close a transaction and they have to pass on their long-term capital gains to their shareholders. That's the benefit of investing with private equity over real estate in a real estate investment trust. You get the benefit of when small private companies increase in value. If you invested $10,000 in GAIN in 2018, that $10,000 would be worth $18,955 today, with the dividends reinvested. Then starting today, if you invested $10,000 in GAIN, you could expect about $614 a year in dividends, at a 6.14% yield. That too would give you on average about $51.23 a month in dividends. This of course doesn't include the special dividends that the company pays from time to time. The next stock is Gladstone Land, ticker symbol LAND, Land. This is an $800 million market cap company that was founded in 1997. And what Land does is it's a real estate investment trust that acquires and owns farmland located in major agricultural markets in the US and then leases its properties to third-party farmers and tenants. Gladstone Land currently owns 164 farms comprising of approximately 113,000 acres in 15 different states, all of which are valued at about $1.5 billion. These farms grow a variety of non-staple crops such as peas, almonds, cabbages, and they actually even have a few algae farms in Florida. The company pays monthly distributions to its stockholders and has paid 93 consecutive monthly cash distributions on its common stock since its initial public offering in January of 2013. Land makes most of its revenue through rents paid to the company by the farmer tenants and through participation rents. This means that when a farmer sells their products at a grocery store at a profit, Land gets some of that profit alongside the farmer. Because of recent increases in the price of food, the company's stock price has gone up dramatically since 2020, and the dividend yield is currently 2.37%. With food prices and cost of living going up, this stock has become very popular to own recently, considering that they only have one publicly traded competitor, and that company is Farmland Partners, or FPI. FPI's dividend yield is lower than Gladstone Land's, and they pay quarterly dividends rather than monthly dividends. Land's dividend yield may be higher, but the dividend itself has been growing very slowly, but this shouldn't be surprising to you as investing in farmland is generally considered to be a long-term investment. Usually farms steadily produce value for their owners rather than dramatically skyrocketing in price like a tech stock. In terms of performance, Land year-to-date has underperformed the S&P 500 in stock price, losing 30% versus 18% for the S&P 500. This has a lot to do with the pullback in the stock's price recently that happened early this year in April, but before that the company was dramatically outperforming the S&P 500. If you invested $10,000 in Land in 2018, that $10,000 would be worth $20,191 today, with the dividends reinvested. During that same time period, an investment in SPY, or the S&P 500 ETF, would be worth only $15,621. Then starting today, if you invested $10,000 in Land, you could expect about $234 a year in dividends at a 2.33% yield, and that would get you about $19.52 a month on average in dividends. The next monthly paying dividend stock is Philip Edison & Company, or ticker symbol PECO, PECO. This is a $4.3 billion real estate investment trust that focuses on grocery-anchored shopping centers. And what these are is they're kind of strip malls where you see they have one major grocery store or supermarket like a Kroger, Whole Foods, or Publix, and then next to it there's a series of smaller businesses. But the main focus of that shopping center is usually the grocery store. This stock pays a 3.17% dividend yield. This company is over 30 years old but only started trading on the stock market recently in 2021 and doesn't have a very long history of paying out dividends to its shareholders. There's only one dividend increase on record for PECO when they increased their dividend half a cent to 9 cents per share in September of 2021. In terms of performance, PECO year to date has dramatically outperformed the S&P 500, with their stock price gaining 1.13% year to date versus negative 18% for the S&P 500. If you invested $10,000 in PECO in 2018, that $10,000 would be worth $12,611 today with the dividends reinvested. And then starting today, if you invested $10,000 in PECO, you could expect about $318.60 a year in dividends at a 3.17% dividend yield. And that would give you $26.55 a month in dividends. Sabine Royalty Trust, which trades under the ticker symbol SPR, is an $868 million market cap company that holds royalty and mineral interests in various oil and gas properties in the United States. The company's royalty and mineral interests include landowners' royalty, overriding royalty interests, minerals, production payments, undeveloped oil and gas properties located in Florida, Louisiana, Mississippi, New Mexico, Oklahoma, and Texas. Sabine Royalty Trust was founded in 1982 and is based in Dallas, Texas. The dividends this company pays out monthly wildly swings back and forth depending on the price of oil or the minerals or mining concessions or digging out of the ground. And as you can imagine, this company has benefited a great deal from the increase in the price of oil and the cost of energy. In terms of performance, SPR year to date has dramatically outperformed the S&P 500 in stock price, gaining 41.78% year to date versus negative 18% for the S&P 500. If you invested $10,000 in SPR in 2018, that $10,000 would be worth $19,144 today with the dividends reinvested. And then starting today, if you invested $10,000 in SPR, you could expect about $1,102 a year in dividends at 11.0% yield. And that would get you $91.85 a month in dividends. I want to remind you though that while this company hasn't missed a month of dividends, the amount they pay out every month is highly erratic. So if you're looking for consistent dividend income, you might want to consider other stocks. Next up is ticker symbol SJR, and Shaw Communications is a $14 billion market cap Canadian company that focuses on connectivity and telecommunications. They sell internet services, Wi-Fi, phone, satellite connections, and fiber optic data connections throughout North America, but with a primary focus on the Canadian market. They're pretty much the equivalent of Verizon in the United States and collect mobile phone and internet subscription revenues from households and businesses in Canada. Their dividend yield is 3.28%, and their monthly dividend has stayed pretty consistent for the past decade. In terms of performance, SJR year to date has slightly outperformed the S&P 500 in stock price, losing 8.3% year to date versus negative 18% for the S&P 500. If you invested $10,000 in SJR in 2018, that $10,000 would be worth $14,504 today with the dividends reinvested. Then also starting today, if you invested $10,000 in SJR, you could expect about $327.59 a year in dividends at a 3.27% yield, and you would get about $27.30 a month in dividends. The last monthly dividend company on this list is STAG, ticker symbol STAG, otherwise known as STAG Industrial. STAG is a $5.6 billion market cap real estate investment trust focused on the acquisition and operation of single-tenant industrial properties throughout the United States. By targeting specifically industrial and distribution properties, STAG has developed an investment strategy that helps investors find a powerful balance of income plus growth. STAG has 551 industrial buildings in 40 states, leading to a combined total of 110 million square feet. You can see that most of their properties are distribution warehouses, with only the occasional few that are pure manufacturing or industrial centers. These distribution centers they lease feed major retailers like Walmart and Amazon, as well as benefit from the increase in e-commerce activity because these distribution centers store, ship, and receive e-commerce products to their customers all across the United States. In terms of performance, STAG year to date has underperformed the S&P 500 in stock price, losing 35.98% year to date versus negative 18% for the S&P 500. If you invested $10,000 in STAG in 2018, that $10,000 would be worth $13,905 today with the dividends reinvested. Then starting today, if you invested $10,000 in STAG, you could expect about $484.72 a year in dividends at a 4.84% dividend yield, which would come out to $40.39 a month in dividends. This is a very popular to-go stock for dividend investors, and the only downside is that their dividend has only been increasing by a few fractions of a penny every year, but some dividend growth is always better than nothing. That's all for this video. Watch this video next about how to make money from a crashing stock market by using inverse ETFs, and become a channel member for more advanced investing content.